September 2008. The global financial system is on the verge of a total blackout. Lehman Brothers has vanished. Merrill Lynch is gone. AIG is hemorrhaging billions every hour. In Washington, the halls of the Treasury are filled with the smartest minds in the country. But they have a problem. They are staring at a black box of toxic debt worth trillions and no tools to open it. There is only one person who has the map. One person who spent the last 20 years building a digital, unblinking eye that can see through the wreckage. The government didn't call the big banks to save the world. They needed someone to handle the toxic waste. And there was only one man that could lead through that darkness. They called Larry Fink. Larry Fink, the man behind BlackRock. Today, he manages more money than the GDP of almost every nation on Earth. $14 trillion. But before he was the shadow sovereign of Wall Street, he was a man who lost everything. Who is Larry Fink? Lawrence D. Fink, also known as Larry Fink, is one of the co-founders of BlackRock. He is also the chairman and CEO of the company, the largest money management firm in the world. It's the first time in history a company manages to reach such a milestone and gives a clear picture of how BlackRock operates. Not just a traditional investment bank, but as a central pillar of the global financial infrastructure, where its sheer scale allows it to influence economies and industries at a level previously reserved only for nation-states. Founded in 1988 as an investment firm that prioritized risk management, with $11.5 to $14 trillion under management, BlackRock's influence is staggering. BlackRock is a top 3 shareholder in nearly every company in the S&P 500. From Apple to Exxon, from Microsoft to Nestle. They don't just invest in the market, they are the market. But its reach is personal. It holds the retirement dreams of over 35 million Americans. This is the story of how a kid from a California shoe store became the custodian of the world's wealth. But who is Larry Fink? Lawrence Douglas Fink entered the world on November 2, 1952. Born in Los Angeles, California, he was raised in a Jewish family in the heart of San Fernando Valley, the quintessential American suburb of Van Nuys. His home was a balance of academic discipline and retail grit. His mother, Leela, was an English professor who valued the power of language and education. And long before he pulled the strings of the global economy, Larry Fink was learning the value of money on a much smaller scale. His father's shoe store in Van Nuys, where he spent evenings helping and learning the business. As one of 3 children, Larry grew up in a household where hard work wasn't just encouraged, it was the baseline. While he often joked he wasn't the smartest in the room, it was this specific combination of his mother's intellectual curiosity and his father's Main Street business sense that would eventually form the DNA of a global financial giant. While the future titans of Wall Street were rubbing elbows in the marble halls of Harvard or Yale, Fink was a Bruin. In 1970, Larry arrived at UCLA. For a young man from Van Nuys, this wasn't just a local university, it was a world of ideas. But it was in his final years that the trajectory of his life shifted. He immersed himself in political science, learning how power moves through nations. But he soon realized that in the modern world, power follows the money. This led him to the Anderson School of Management, specializing in real estate. It was here that he began to see the world through the lens of assets and yields. This public education gave him a different edge. While his peers at private East Coast schools were being groomed for traditional corporate roles, Larry was developing the outsider's eye, a perspective that allowed him to see opportunities in the messy, unpolished corners of the bond market. He graduated in 1976, not with a silver spoon, but with a California-bred ambition to take on the giants of Manhattan. He was a Bruin headed for Wall Street, and the financial world had no idea what was coming. The year is 1976. New York City is a grit-covered battlefield, and Larry Fink has just been handed the keys to the kingdom. Goldman Sachs, the most prestigious name in finance back then, has practically hired him. He had passed the technical tests. He had charmed the partners. All that remained was a rubber stamp interview with human resources. But Larry wasn't just confident, he was impatient. When the recruiter asked for his thoughts on the firm, Larry didn't give a thank you, he gave a consultation. He pointed out the flaws in their system. At Goldman, they wanted a soldier. Larry was already acting like a general. In that room, the rigid Goldman way clashed with the unfiltered Fink way. Before he could even hail a cab back to his hotel, the offer was dead. The most coveted job in Wall Street history had vanished, all because Larry Fink couldn't stop himself from trying to fix a system he hadn't even joined yet. It was a crushing blow. But in the shadow of that rejection, a door opened at a scrappy second-tier firm called First Boston. It was a place with less prestige, but more white space. At Goldman, he would have been a cog in a perfect machine. At First Boston, he was the architect. He was given a desk, a telephone, and the freedom to build something entirely new: the mortgage-backed security. He didn't know it yet, but that recruiter's no was the foundation upon which the $14 trillion empire of BlackRock would be built. It's 1976 when Larry Fink arrives at First Boston. At the time, the firm was the scrappy underdog of investment banking. It wasn't as stiff as Morgan Stanley or as elitist as Goldman. It was the perfect laboratory for a man who didn't fit the mold. Larry was assigned to the bond department. Back then, bonds were considered the boring corner of finance. It was where you went to retire. Stocks were sexy. Bonds were for grandmothers. But Larry saw something everyone else missed. He looked at the American dream, the suburban house, the white picket fence, the 30-year mortgage, and he saw a math problem. He realized that if you took thousands of individual home mortgages, bundled them together like a deck of cards, and sold slices of that deck to investors, you created a money machine. This was the birth of the securitization market. What Larry Fink helped create was more than a financial product. It was a structural shift. Securitization didn't just bundle mortgages. It separated risk from reality. For the first time, financial value could travel faster than the underlying economy that supported it. A house in California became a line in a spreadsheet in New York, which became a yield sold to an investor in Tokyo. Risk no longer lived where decisions were made. It was abstracted, sliced, repackaged, and distributed across the system. This was the moment when finance stopped reflecting the real economy and began building a parallel one. A system that could grow without limits, as long as everyone believed the models were right. And for a while, they were. By the early 80s, Larry was the golden boy. He wasn't just hitting targets, he was shattering them. In 1 year, his department was responsible for nearly 1/3 of First Boston's total profits. At age 31, he became the youngest managing director the firm had ever seen. He was earning millions. He was the successor, the prodigy, the man who could do no wrong. He had moved to his family to a sprawling estate. He was flying private. He had conquered the grit-covered battlefield of Manhattan. But in the world of high finance, the higher you fly, the thinner the air becomes. Larry was making hundreds of millions for the bank, but there was a ghost in the machine. a variable he hadn't accounted for. The year was 1986. Larry had made a massive bet on interest rates. He believed they would stay stable. He was so sure of his math, so confident in his track record, that he didn't realize the ground was shifting beneath his feet. In just 3 months, the Golden Boys department went from profit to a catastrophic $100 million loss. In the 80s, $100 million wasn't just a loss, it was a national scandal. Overnight, the man who was supposed to run the bank was a pariah. The phones stopped ringing. The friends on the trading floor looked away when he walked by. He had been the smartest man in the room until he wasn't. He would later describe this moment as the most painful experience of my life. But as he sat in the ruins of his reputation, Larry Fink wasn't just mourning his career, he was obsessed with one question. How did I not see the risk? That obsession, the fear of the unknown variable, would become the cornerstone of BlackRock. By 1983, Larry wasn't just selling bonds, he was a pioneer of the CMO, collateralized mortgage obligation. Think of it like a waterfall. Larry took thousands of mortgages and sliced them into tranches. Some investors took the top slice, low risk, low reward. Others took the bottom, high risk, high yield. It was a masterpiece of financial engineering. It made the illiquid liquid. It made First Boston the center of the universe. But there was a flaw, a tiny mathematical ghost in his models. Larry's team had predicted that interest rates would rise, and they hedged their bets accordingly. But in the second quarter of 1986, rates did something the models said was impossible. They plummeted. Because they didn't have a system to track their real-time exposure, Larry was flying blind. He was the pilot of a Boeing 747 trying to land in a storm using nothing but a compass and a prayer. By the time he realized the engines were on fire, the plane had already hit the mountain. $100 million, all gone. He wasn't just fired, he was erased. After the dust settled, Larry found himself in a peculiar kind of exile. He wasn't just unemployed, he was haunted. He realized that the $100 million loss wasn't a failure of talent, it was a failure of vision. What happened in 1986 wasn't a personal miscalculation, it was a systemic blindness. At the time, every major financial institution operated the same way. Positions were fragmented. Exposure was estimated, not measured. Risk was inferred after the fact. Banks knew what they bought yesterday, but not what it was worth right now. The system rewarded speed, volume, and confidence, not understanding. And as long as markets moved slowly, the illusion held. But once volatility entered the market, no one truly knew where the danger was, or how large it had become. Larry didn't just lose money, he realized the entire financial system was flying without instruments. Wall Street was essentially a collection of blind giants. Every major firm, Goldman, Lehman, Merrill Lynch, was standing just 1 inch away from total collapse at any given second. Why? Because they didn't actually know what they owned. This was information blindness. In the 1980s, you knew what you bought yesterday, but you had no idea what it was worth right now. A sudden shift in interest rates or a political coup across the ocean could vaporize $1 billion before the morning coffee was poured. Larry understood a terrifying truth. The entire global financial system was built on a foundation of guesswork. It hit him with the force of an epiphany. If he could build a brain, a machine that could see the risk that humans were too slow to calculate, he wouldn't just be a banker. He would be the only man in the world with a flashlight in a dark room. This realization changed his entire philosophy of investing. He stopped looking for the big score and started looking for the safe passage. He didn't want to beat the market anymore. He wanted to measure it. He would later tell his partners, "We are never going to be blind again." That vow, born from the humiliation of 1986, became the blueprint for a new kind of firm. A firm that didn't rely on the ego of a star trader, but on the cold, unblinking eye of technology. Larry Fink was a man with a vision, but he was also a man with a tainted resume. To the rest of Wall Street, he was the guy who lost $100 million. But to a small circle of insiders at First Boston, he was the only one who truly understood why it happened. He began making calls. He wasn't offering high salaries or flashy offices. He was offering a chance to build a holy grail, a financial firm where technology governed the ego, not the other way round. And he eventually found the right people to help him build that holy grail. Rob Capito, the enforcer, a powerhouse trader who knew the plumbing of the bond market better than anyone else. He provided the muscle Larry needed to execute the vision. Ben Golub, the oracle, a PhD with a mind like a supercomputer. While other bankers were focused on lunch reservations, Golub was thinking about value at risk and Monte Carlo simulations. Susan Wagner, the mastermind, brilliant, calculating, and capable of seeing structural flaws in a multi-billion-dollar merger before a single paper was signed. Along with Barbara Novick, Ralph Schlosstein, Hugh Frater, and Keith Anderson, they became the original 8. Fink wasn't looking for bankers who would run after the money. He wanted architects, people who were tired of being blind. When he found them, they met in living rooms and coffee shops. They had the blueprints for a system they called Aladdin, an acronym for Asset, Liability, Debt and Derivative Investment Network. It was designed to be the unblinking eye Larry had dreamed of in his exile. But a brain without a body is just a dream. To build Aladdin, they needed hardware. They needed offices. And most importantly, they needed the one thing Larry's reputation had cost him: capital. Aladdin was not designed to beat the market. It was designed to understand it. But its real power emerged when others started using it. Banks, insurance companies, pension funds, sovereign institutions. As Aladdin spread, something subtle happened. Risk stopped being subjective. It became standardized. When Aladdin flagged an asset as dangerous, entire markets adjusted accordingly. Not because Larry Fink said so, but because the system trusted the model. At that point, BlackRock was no longer just managing money. It was helping define how risk itself was understood. And whoever defines risk defines the boundaries of decision-making. Enter Stephen Schwarzman. In 1988, Schwarzman was the rising king of private equity. His firm, Blackstone, was aggressive, wealthy, and hungry. The meeting was tense. Schwarzman knew Larry's history. He knew about the 1986 disaster. But Larry didn't hide from it. He used it as his primary selling point. Because Larry had seen the end of the world already, he knew exactly how the lights went out, and because of that, he was the only one who knew how to keep them on. Larry's pitch was revolutionary. He didn't want to start a hedge fund, he wanted to create a fiduciary company, a firm that managed other people's money with the same technological rigor usually reserved for NASA. He asked for a $5 million credit line and a partnership. In exchange, Schwarzman would own 50% of the new venture. He knew he was buying cheap because he was buying on a distressed asset, Fink's damaged reputation. But he did so betting on the idea that the experience had turned Larry Fink into some sort of financial genius. The deal was done. On a Friday in March 1988, the team moved into a single cramped room within Blackstone's offices. They were 5 computers, a few folding chairs, and a mountain of cables on the floor. They were under the Blackstone umbrella, but Larry knew that this was just a temporary shelter. He didn't just want a department, he wanted an empire. He had the money, he had the team, and in the corner of that small room, the first lines of code for Aladdin were being written. The information blindness was over. The era of BlackRock, though it didn't have that name yet, had begun. The first office of Blackstone Financial Management wasn't a glass tower. It was a glorified closet. Because of the heat generated by the early Sun Microsystems workstations, the temperature in the room rarely dropped below 80 degrees, 27 degrees Celsius. While the rest of the Blackstone group was out at expensive lunches, closing leveraged buyouts, Larry's original 8 were building a digital fortress. They were the weirdos in the basement. It was here that the name Aladdin became a living thing. Every day, Ben Golub and his team fed it data, interest rates, housing prices, historical crashes. They were teaching the machine to be afraid of everything Larry hadn't seen in 1986. By 1992, the department inside Blackstone was no longer a startup. It was a powerhouse. Larry's team was managing $17 billion. They weren't just a side project anymore, they were a significant engine of Blackstone's growth. But with success came a toxic byproduct: identity confusion. Clients were getting confused. They would call Blackstone looking for Larry's bond expertise or call Larry looking for Schwartzman's buyouts. But the friction went deeper than a name. It was a war of philosophies. Schwartzman was a deal maker. He wanted to own companies. Fink was a fiduciary. He wanted to manage risk for others. The tension was similar to having 2 predators in a cage too small to fit both. The breaking point came over equity. Larry wanted to use stock to attract and keep the original 8 and new talent. Schwartzman, holding 50% of the firm, didn't want to dilute his stake. The partnership that saved Larry's career was now suffocating his vision. In 1994, they reached a deal. Schwartzman agreed to sell Blackstone's stake for $240 million. At the time, it seemed like a win for Schwartzman, a massive return on his $5 million investment. It wasn't just about money, it was about the spotlight. Schwartzman was the king of Wall Street, but his subtenant, Larry Fink, was the one the New York Times wanted to interview. But for Larry, it was the price of freedom. Schwartzman would later call selling BlackRock the worst mistake of my career. For Larry, the divorce was the moment the training wheels came off. He was no longer under anyone's umbrella. He was the CEO of an independent firm. Now he just had to prove he could survive the coming storm of the late 90s. It is 2008. The financial world was experiencing a heart attack. The financial smoothies that mortgage-backed securities Larry had helped create 30 years earlier had turned into a global poison. Banks didn't know what they owned, and more importantly, they didn't know what their neighbors owned. Trust had evaporated. When the US government realized the economy was on the brink of a total blackout, they didn't call Goldman Sachs. They didn't call JP Morgan. While the CEOs of Lehman and Merrill were begging for government checks, Larry Fink was the one the government called to write the checks. He was the only titan left standing with a clean balance sheet. The United States government didn't just seek advice, it delegated responsibility. BlackRock was tasked with valuing assets no one understood, managing risks no one could measure, and stabilizing markets that were collapsing in real time. This wasn't a bailout. It was an outsourcing of core sovereign functions. For the first time, a private firm played a central role in maintaining global financial stability, not through political authority, but through technical capability. From that moment on, power was no longer just about laws and institutions. It was about who had the tools to see the system clearly. BlackRock was hired to manage the toxic waste of the crisis. They became the official cleaner for the US government, managing $130 billion of troubled assets. Suddenly, Larry Fink was the most powerful man in the room, acting as an advisor to the president and the treasury. But while he was saving the system, he saw a once-in-a-lifetime opportunity to dominate it. In the middle of the carnage, Barclays Bank in the UK was desperate for cash. They needed to sell their crown jewel, a division called Barclays Global Investors, which included a revolutionary product called iShares. iShares represented passive investing, ETFs that tracked the whole market rather than trying to beat it. It was the ultimate expression of Larry's philosophy: stop betting on stars and start owning the system. It was a massive $13.5 billion gamble. If the markets continued to fall, the deal could sink BlackRock. But Larry knew something the others didn't. He had looked into the eye of Aladdin, and Aladdin told him that the bottom was near. With the acquisition of iShares in 2009, BlackRock doubled its size overnight. They weren't just a bond shop anymore. They were now the largest money manager on the planet. They had gone into the crisis as a respected firm. They came out of it as the shadow government of finance. By 2012, Larry Fink had built the machine. He had the assets, the data, and the influence. But he realized that being king of Wall Street wasn't enough. He wanted to change the way the world did business. Every January, a ritual began that would send tremors through boardrooms from Detroit to Frankfurt. Larry started writing letters. They weren't just annual reports. They were the BlackRock manifestos. In 2018, he dropped a bomb. He told the world's CEOs that if they wanted BlackRock's money, they had to prove they served a social purpose. He wasn't just asking for profits, he was asking for a soul. He was mainstreaming ESG, environmental, social, and governance. And he was doing it with a $10 trillion hammer. But Larry's new gospel didn't sit well with everyone. By 2021, the Golden Boy was finding himself in the middle of a two-front war. The ESG debate was never cultural. It was economic. At its core, ESG was about risk management anticipating regulation, climate disruption, and social instability. For BlackRock, ignoring those factors wasn't neutral. It was dangerous. But when capital begins to price the future, it also begins to shape it. That's why the backlash was so intense. To the left, Larry was a hypocrite. They called him a greenwasher because BlackRock still held billions in oil and gas stocks. To the right, he was a globalist villain who was using other people's money to push a radical environmental agenda. The backlash turned into a full-scale political assault. State treasurers in Florida, Texas, and Mississippi began pulling billions out of BlackRock. They accused Larry of boycotting energy and violating his duty to investors. For the first time, the man who had mastered risk found himself in a risk he couldn't calculate: the culture war. He told a crowd in Aspen that he was ashamed to be a part of the debate. He even stopped using the term ESG altogether, calling it weaponized. He had tried to become the conscience of capitalism. Instead, he became its most controversial target. But even as the politicians shouted and the protesters marched, the assets kept growing. Because in the end, whether you loved him or hated him, you couldn't escape the machine he built. January 2026. The number flashes on a terminal in BlackRock's Hudson Yards headquarters. $14 trillion. It is a number so vast it defies human comprehension. If Larry Fink's assets under management were a country's GDP, it would be the third largest economy on Earth, surpassed only by the United States and China. But as Larry looks out from his office, he isn't looking at stock tickers. He is looking at the very bones of civilization. In 2024, Larry made his final, most aggressive pivot. He realized that the next decade won't be one with bits on a screen, but with atoms in the ground. With the $12.5 billion acquisition of Global Infrastructure Partners, Larry signaled the end of the old Wall Street era. Larry saw the AI revolution coming, but he didn't buy the chip makers. He bought the power plants that feed the chips. But every empire faces the same inevitable question: succession. For years, Wall Street has whispered about who could possibly replace the man who is BlackRock. Names like Rob Capito, Mark Weirman, and Jennifer Johnson swirl in the press. But the truth is more complex. Larry hasn't just built a company, he's built an organism. A system where Aladdin, now a very sophisticated AI entity, handles the risk while a legion of 20,000 employees executes the vision. Aladdin is no longer just a calculator. It is a predictive engine that runs millions of simulations every second, anticipating everything from a war in the Middle East to a crop failure in Brazil. Some call him the king of the world. Others call him the shadow architect. But if you ask Larry, he'll tell you he's still that kid from the Van Nuys shoe store, just trying to make sure that the maths add up. He took the greatest humiliation of his life and turned it into a shield for the global economy. He taught the world that profit without a plan is just a gamble, and that in the dark, the man with the flashlight is king. There is one financial question the system cannot answer. What happens when everyone measures risk the same way? When models converge, when assumptions align, when diversity of judgment disappears? A system optimized for stability can become fragile, not because it is wrong, but because it leaves no room for the unexpected. When the supervisor becomes invisible and the rules are embedded in code, accountability becomes harder to locate. The system works until it doesn't. And that's why BlackRock isn't just a shareholder in your company. They are the landlord of your power plant, the owner of your airport, the architect of your retirement. It is a level of centralized influence the world has never seen in a private individual. Lawrence D. Fink didn't just build a bank, he built the unblinking eye of capitalism. And as the world moves into the era of AI, climate shift, and global restructuring, one thing is certain: BlackRock will be there, watching, calculating, and growing.